private market values for this Claiborne. Now, the reason you might want this information, and it's the sales information that you don't actually have. I think you have, I've abbreviated the purchase price information a little bit. I've subtracted the actual assets. Is that if you want to get a private market value for the Liz Claiborne brands, you've got a lot of brands. They buy brands all the time. What's missing from the annual that you have is the scale of what they're buying. So you know what they pay for the brands, but you don't know the scale of what they're buying relative to the scale of the existing brands. And this is just information on the scale of what they're buying, which is in terms of sales. Now, I could give you, and decided not to, but if you go to old reports, you may be able to get it, the information on operating income. Why do you think I don't think that's necessarily relevant? Well, it's because when Liz Claiborne buys these brands, it's not really going to let them run independently. So it's not buying standalone businesses. What it's buying are product lines that it integrates into its basic business and purchases for and does all those things for on a consolidated basis. So presumably the earnings are going to be much higher based on whatever economies Liz Claiborne brings to the management of these brands, especially in distribution, than otherwise. So are there any questions about this? Because if not, Sarah? Yeah, can you put it on?
Yeah.
It'll be up. Hopefully it's got to be up, unfortunately, soon because we're doing this on Thursday. All right, next. Paul Socken will be here on Wednesday. Remember, you voted for a Wednesday. February 22nd, 2006, from 6:30, if that's okay, or we should start at 6:35, which is when we normally start, to 8:30 or so. We'll be in this room. You have the room. It's the last thing on your schedule. Fortunately, since we're not going to overbook, because John Reinsberg has canceled. He could not fit it in with the Jewish holidays. So big problem. So there will, in fact, be exactly 16 speakers if you count the Buffett trip as a speaker. The reason Paul couldn't do it on the John Reinsberg date is that he too had holiday issues. All right, any questions about that? Any questions about the Buffett trip that I can't answer? Yes.
About the list, the percentages that you had on the transparency, were those percentages of the acquisition price?
Oh no, that's percentage of the companies that they bought.
Oh.
So the 89 to 113 million. The reason it's that large a range is that there is an incentive payment at the end of 5 years. The actual incentive payment is between 15 and 45 million. I discounted it to 12 to 36 million. But that was for 85% of London. And the 42 million is for 87.5% of cigarettes. Okay, sorry, but the sales are for the whole company. All right, next. All the people who are in economics of strategic behavior can go home tonight. Because what I'm going to do tonight is literally do a one-class summary of that whole course. And I will not be offended. This is your one vacation. Advantage of it. Not only because there are not a lot of seats in the room. will recognize all the e-browsers that are in that other file. This is more like this is class. You're in strategic behavior.
I'm obliged to punish you.
Thank you, Commissioner. All right, what we were talking about at the end of last time was valuation methodology. Fundamentally, there are two sources of valuation. There are two aspects of a company's economic situation that typically lead to sustainable earnings. You're used to thinking about sustainable earnings in terms of forward-looking projections. But at the heart of the idea of sustainability is what guarantees that what you think are going to be earnings 5, 10, 15 years from now are really going to be earnings 5, 10, or 15 years from now. One source of earnings is assets. Continue requires assets, and it's a viable business, then the average return in the future has got to be sufficient to keep those assets in the business. Above the asset value, you can also get excess earnings. But for them to be sustainable, there has to be a franchise, a competitive advantage, or a barrier to entry. Otherwise, as we talked about briefly, and we're going to talk about a lot more tonight, those above average earnings are unlikely to persist in the future. Now, sometimes a company will, on an accounting basis, look like it has above average earnings. That's only because very often you'll see that in the denominator they've left off a huge amount of assets. So just offhand, you think of the rag trade as a business with powerful competitive advantages. No, you think anybody could get it. On the other hand, you'll see Liz Claiborne, even superficially, earns what looks like an above average return on its equity. In practice, what's the missing asset from the balance sheet there that you have to look at? The brands. That if you were trying to get into the business to compete with Liz Claiborne, you would have huge expenditures for brand development, advertising, distribution, and getting them. That doesn't appear on the balance sheet unless they buy it in a transaction, in which case it appears as goodwill. So assets are one thing. Above assets, you have to have a competitive advantage. We already saw case A in action. Sometimes the assets do not earn what they should. You have a bad man, you'll see a lot of the potential value just not be returned to shareholders in the form that you get your hands on either from stock buybacks or from dividends, ultimately. Hudson General is a classic case of that. You look at the asset value, you look at the earnings power value, the asset value is about $100 billion. The earnings power value, if you're lucky, is $50 billion. This is for the whole company. There, the critical consideration for investment is what would it take to realize the asset value. Now, sometimes you'll be lucky. Sometimes you'll be able to buy it for less than the 50 million earnings power value, and then you can probably afford to wait. But you'll hear from the professional investors a lot about something called a value trap, which is something that looks like it's our asset values of 100, 150 million. You've got earnings power values of 50 million, and it's sort of trading at 60 million, and you think, boy, this is great. And nobody ever gets rid of the management. And they pass the company on to their spawn, who passes the company on to their spawn. And you never make sure that there's some sort of a catalyst that is going to create the value. The second case is one that's, in a way, self-evident. Asset value, you look at the current earnings, and they're exactly what you'd expect to see. In addition, you think that there's nothing to interfere with the competitive process, so you would expect the earnings to be driven to a level that's appropriate to support that level of assets. But very often, lots of investments, and including value investments, are cases where the assets valued intangibles, in the way we're going to talk about with Liz Claiborne, the earnings power values are well in excess of the asset values. But these are companies that just have stratospheric earnings relative to the amount of money that's been put into business. And the question then is, how do you recognize that kind of a company? And what do you look for in evaluating the extent to which those earnings are sustainable, and as it's going to turn out, the extent to which the growth in those earnings and the growth in that company is going to create value in the future. And that's what we're going to talk about today. Now, the way most people do it is a way that will be familiar to you, which is that you do an Excel model. This is a new business or an existing business, you do a business plan. And I assume in future market size, you estimate the share of the market you think your company is going to garner, or you just start with a trend growth rate to revenue, of operating margin, you apply an operating margin to that, that gives you operating income, you subtract taxes from that, and then you subtract the cash flow investment necessary to fund whatever growth you're looking at. The end of that you get, and that's for, by the way, both fixed and working capital. At the end of that, you ought to get a free cash flow number, a concept that ought to be familiar to all of you. You estimate a cost of capital. It shouldn't be NDP there. It should be NPV. How do you do that? Well, you got taught to do that with a beta. Forget the beta. And the reason did I do this demonstration for you last time? I don't think I did when we were talking about, but if I did, let me know. Suppose you're estimating a weighted average cost of capital, and it's going to be the cost of debt times the fraction of debt financing plus the cost of equity times the fraction of equity financing, which is 1 minus the fraction of debt financing, and you're going to estimate the cost of equity as a risk-free rate plus a beta times a risk premium. The rate is long-term now about. Anybody? 3% say, is that? What's an average beta? 1. It's almost got to be by definition. What do you think the error brackets are in a typical beta estimate? If you use a different 6 months, what do you think the errors, the range of estimates for betas are that you get? Have you ever seen a beta picture? You look at the return on the market, either monthly or daily, and you look at the return on the stock, and it looks like this swarm of bees, and you fit a line to it, and the slope of that line is the beta. Does this resonate here? Anyway, the typical error that you see is plus or minus a half. What do you think the risk premium is? Did they give you a number for that? They gave you 5, 8, 7. You see, that's a good range. You'll see numbers. So how accurate is this beta measure? Well, at one point it could be 3 plus 1/2, which is the lower value on the beta, times 4, which is 5% as a cost of equity. On the other hand, it could be 3 plus 1.5, which is the upper level on the beta, times 9, which is 60. 1.5 times 9 being 13.5, 13.5 plus 3 being 16. How useful is that as a measure of the cost of capital? Not too damn useful. You're much better off using your judgment that at minimum the cost of capital is going to be at least the cost of debt that they're paying. At a maximum these days, it's going to be 15%. Where do I get the 15%? Talk to venture capitalists, which typically are the riskiest kind of equity capital, and you ask them, what return do you have to show on your previous funds to fill your next fund? They'll give you a number of about 15%. That used to be about 18 for a brief period in the early 80s. That was sort of 19. 15 is the upper limit, and say 7, which is the cost of debt, is the lower limit. Notice that's a better estimate just doing that than the beta estimate is likely to be. But there is a lesson in this. When you estimate that cost of capital and calculate the net present value and see whether this is a positive or negative net present value project or investment, and embedded in the process that you've gone through at every stage where you pick a parameter is a huge amount of error. We talked about the error in the terminal value I think a week ago, but there are errors all the way along. When you estimate the investment level, that is the cash flow to support growth, you're making assumptions about a growth rate, and you're making assumptions about technology and costs that who knows if they're true. When you estimate operating margins, you're not only looking at technology and costs, but implicitly also at prices, and therefore what the competitive responses of other companies in the field are likely to be. The same applies to your market share and growth rate. So you've got embedded in this process a huge number of assumptions of whose accuracy you have no idea. And the history of this is, especially within companies, that individual investors can talk themselves into almost anything using this technique. So what you would like to do is stop and say, at the end of the day, does this valuation make sense? Or in fact, have I talked myself into investing in the Darfur of the investment world? It used to be the South Bronx, but that's improved enough. So. And then now the first way you thought about doing that was to look at 5. In economics of strategic behavior, you ought to have a sense that's almost a complete waste of time. Even Michael Porter recognizes it's a complete waste of time. Implicitly, not explicitly. How many of you read his book, Competitive Analysis, the basic? Don't they make you read that in your strategy course? Sorry?
Just the article.
Oh, just the article? If you read that book, he talks about 5 forces, but he also talks about 2 generic strategies, which are niche strategies or low-cost strategies. My question to you is there any connection at all between the 5 forces and those 2 strategies? The answer is no. So if he jettisons his framework when he's looking for strategies, lots of luck, you're using it. Also 5 forces. I mean, it's better to work with one. So in a fundamental sense, this is 5 forces too many. Well, what I want to do is talk about what the fundamental force is, probably strategically, but most importantly for evaluating whether returns above a net asset value are going to be sustainable. And I want to talk first about a kind of industry that you all ought to recognize has no competitive advantage. And just think of any pure commodity business where the only dimension of competition is price. Wheat is one of them. And there, you don't think of wheat farmers or steel producers having strategies. They just operate as efficiently as they can against a given market price in their locality or for their particular product. Actually, can somebody give me my pen? I don't really need it to walk with it. Oh, no, I got it. I got it. That's okay. Oh, I needed to point with. Well, suppose that was the situation, that you had a price at which, taking into account all the costs, there were output levels at which a firm, before it ran into capacity constraints, could make money. That is, it could produce output at a cost that was below the price that it was getting. What it would appear as in accounting terms is it would show up as a return on equity or a return on capital well in excess of the cost of equity or the cost of capital. Be a 20, 23, 25% return, and so on. Or in the language of economics, it would show pure economic profit above the cost of all those resources. Jenny, you heard this too, right? You think that also. Well, what is it that happens then? Existing plants expand or other firms enter, and that price gets driven down. Suppose that price was driven down to where the returns on equity were 15%, and the cost of, or returns on capital of 15%, versus the cost of capital maybe 10 or 11. Is that going to stop the expansion? All the evidence is it doesn't. These guys love steel plants dearly, and they're going to build them. And once you build them, they're hard to drown later. They're around for years and years. So typically, prices fluctuate around this level at which there's just no economic profit. Sometimes for short, wonderful periods you make a lot of money. A lot of time you lose money. But on average, you should have a sense you're not going to make money in this. And therefore, in this business, if you saw returns greater than would are justified by the assets you have to employ, you would not expect them to be particularly long-lasting. And you would not want to bet on them. Well, in your marketing courses, what do they tell you to do if you're faced with this kind of a market? They tell you to differentiate your product. They say differentiate your product. It won't be simply a price game, and you'll make money. That is false. It's well marketed, but it's not empirically or logically true. If you think about it empirically, and you think about what the most powerful brands are in the world in traditional brand terms, it's not that people know them, because there are lots of brands like Coca-Cola and Budweiser that have very wide recognition. The issue is, are these brands that you will pay a premium to acquire the goods for? And what's a typical brand where you'll pay a premium? Well, okay, Starbucks is one. Starbucks is interesting. It'll be interesting to see what happens to Starbucks. But if you really think of your self-image, and you think, do you think of yourself, Jeff, as a Starbucks person? I mean, in your fantasies, you imagine driving up to the love of your life's house with 2 cups of Starbucks coffee. I mean, what are the brands that you typically associate with real prestige? They're cars. Lamborghini, Mercedes-Benz if you're a dictator in Africa. Cadillac if you're a dictator in Africa who doesn't care about fuel efficiency. When you look at Mercedes-Benz and General Motors or Cadillac, you think they make above average returns these days. And the answer is they think about it, and a lot of brands with that characteristic do not make the kind of profits that prosaic brands like Coca-Cola or Starbucks seem to make. And if you think about this logically, that ought not to be a surprise. Suppose I start off with Mercedes-Benz, which is a differentiated product, or Cadillac, which is a differentiated product. They don't face a fixed price. They face a demand curve. That they have control over price. If they raise the price, they sell less, but they can raise the price in a way that steel producers start off with a situation where there are output levels, say here, at which you can charge a price and sell it all, where the price that you can charge is way above the cost that you have to pay. And that's again going to show up as a huge return on equity or capital. When that happens in the United States in the 50s, 60s, 70s, and 80s, and over that period, but 70s rather much, yeah, 70s, Cadillac's or even General Motors' return on capital is on the order of 40 to 50%. But then what happens in the luxury car market? Well, first the Europeans decide to enter. As they enter, does Cadillac cut its price? No, it doesn't, because it doesn't have to. But at the old price, what happens to Cadillac sales? They got to go down. They're going to lose Mercedes and the other Europeans. So effectively, what they can sell at each price is going to fall, and that demand curve is going to shift away. There's still going to be a price at which they make money, but now their returns are going to be smaller. Why? Because as their sales fall, what happens to their fixed cost per unit, the cost of R&D and brand maintenance? Goes up. Same fixed cost, fewer units. Slightly higher fixed cost, fewer unit sales. Fixed cost per unit goes up. Prices probably aren't going up, so your margin per unit is falling. What's happened to the number of units you've sold? That's also fallen. So you're making less per unit, and you're selling fewer units. So your profits go down. But suppose they go down to 18%. Is the process, or 20 as they did, 22 to 25%. Is the process going to stop there? No, it's not. Why? Because now the Japanese are going to look at this market. And they're going to say, whether it's Lexus or Infiniti or Acura, we can get in too. And what's it going to take to stop that process of entry? Ultimately, the elimination of the profit opportunity. Is that any different in its ultimate outcome than the straight steel type commodity business? You get overcapacity because they get enthusiastic and overbuild, and then have to try and sell it. So you go through long periods of inadequate returns because the plants, once they're there, and the brands, once they're established, stay there and just... What's the critical thing it takes to sustain the original above-average profitability? What it takes is interference with that process of entry. It's not enough that you differentiate your product. You have to differentiate your product in a way that other entrants can't copy. If they can copy it, they're going to just break up the market until your profits from differentiation, that is, the higher revenues you get, are just offset by the cost of establishing the differentiated product. Unless there's something to interfere with the process of entry, differentiation is not going to save you. So if you are going to see sustainably high levels of return on assets, high levels of return on investment, and you believe they're sustainable, earnings power values in excess of asset values, it better be the case that there is something that interferes with this process of entry. The natural thing that just describes that is, of course, the barrier to entry. And what we're going to talk about tonight is what barriers to entry look like. And what they are, in fact, exactly the same as, and notice we're really just talking about the first of Porter's forces, barriers to entry are exactly the same as incumbent competitive advantages. If you as an incumbent who are earning those above average returns can do something economic that the potential entering competitors can't do, that's going to constitute a barrier to entry. A classic example of that is if you have a lower cost structure. Because if this is the demand that both you and the entrant face, and this is your cost structure, and that's his cost structure, when he can no longer profitably enter, because you've got a lower cost structure, you're going to still make an above average return. What if it was the entrant who had the cost advantage? Would that help you? Well, think about it. Think about the process of competing. Somebody has already started their brand, they've invested, say, in their network, and a new technology comes along, and you, who have not yet built your network, have a cost advantage, because you don't have an embedded commitment to an old technology. What are you going to do to the entrant? You are going to eat his, to the incumbent rather. You're going to eat his or her shorts. And all that investment is not going to earn a return. But once you build your network with your technology, what happens next? The next guy comes along with better technology and eats your shorts. So if the advantage is with the entrant, because the entrant has the latest low-cost version of technology, it's a real version of hyper-competition. And in fact, you probably are not going to get into that market unless you, in the short run, earn an above average, but in the long run, you're going to get undermined by entrants. So it is only incumbent competitive advantages that matter. And fortunately, they come in a small number of varieties. You'd think there are only two. One obvious thing is the one I just described. I can beat a potential competitor because I have a lower cost. What does that involve? What does having a lower cost structure involve? Well, either I've got to have proprietary technology. So I've got a technology that entrants don't have access to. Or I've got to have lower cost resources. How likely is it that you think you're going to have lower cost resources? Quite rare, because resources typically get bid for, like labor and capital, in competitive markets. So usually it'll be a special purpose resource, or you'll have proprietary technology that's either protected by patents on products or processes, or by your working down a learning curve that they can't match. There are two versions of this that are around that, as value investors, I would warn you against. Version one is somebody will come to you, as somebody did to my office tonight, and say, I have a low, I get my capital for 2%, and everybody else has to earn 8%. Is that a competitive advantage? What should you do with that 2% capital? Sorry?
Like government bonds?
No, we should invest it at 8%, right? In other companies or other businesses doing this. Should you pretend that it only costs you 2%? Suppose you sold the bonds once and for all, and you made a windfall, and then inflation and interest rates went up, so you made a windfall profit on your billion bond sale of $800 million. Should you plow all that $800 million back into the business because it gives you a competitive advantage? How many people think you should? Because it's low-cost capital after all. Yeah, you mostly do. Let me ask another question. Suppose you won the lottery, and you won $800 million in the lottery. Would you plow that into a 2% return business? Is that a low-cost source of capital? The answer is no, of course not. With capital, the critical thing is the opportunity cost. If you're giving up 8% returns to invest in this business, the cost of that capital is 8%. And thinking just because you won the lottery that the right thing to do with those proceeds is treat them as if they're free money is called a stupidity, not a competitive advantage. The second version of this, and also sometimes people say, we have deep pockets. Well, the internet mania proved anything. It's that anybody can have deep pockets who's got a plausible story. There are huge amounts of capital out there looking for things to do. In China and, all over the world, there are just huge amounts of savings waiting to be put to work. The other idea is that people sometimes think they're just smarter. Used to be when you came to business school, we'd ask you how many of you thought you were going to finish in the top half of your class. And characteristically, about 90 to 95% of you thought you were going to. And it turns out that we know 45% of you were wrong, we just don't know. The same thing is more or less true about SMART. It's going to turn out, it is true that there are companies that are usually pretty narrowly focused, except for GE, that are extremely well managed, and it makes a difference. But for the most part, smartness belongs to people, not to companies. And people can be hired away from companies, and usually the cost of those smart people is therefore going to be bid competitive. So one possibility is to look mostly for proprietary technology or some special resource that's industry specific that nobody else can get. What's the second natural possibility for a competitive advantage besides proprietary technology? Well, I either have lower costs or I have higher revenue. That the picture looks like this. That because I have high, even though I have the same cost structure as the potential entrants, because I have demand that's higher than the potential entrant, when the potential entrant is just profitable, I can make a ton of money. What's another way of saying that? It's saying I have access to customers that the potential entrant doesn't have. What does that mean? What does it mean to have preferred access to customers? What's another way of saying that, which is probably the right way to think about it if you're asking yourself, are these advantages sustainable? It means you've got to have captive customers in some degree. They've got to be stuck with you and not be available to potential entrants. Coca-Cola is a classic example of customer captivity. People drink Coke out of habit. It is very hard to get them to break that habit. Cigarettes are the same way. With brand loyalty, you wouldn't believe. Toothpaste, for some reason, is the same way. Shampoo and beer tend not to be. So that when you go and you order a beer and it's a Chinese restaurant, what beer do you guys order? Qingdao. You try a Chinese beer. You like it to Budweiser. When you go to a Japanese restaurant, what do you order? Kirin or Asahi. And if you go to a Mexican restaurant, I hope mostly order Mexican. How many of you order Chinese Coke in a Chinese or Chinese Cola in a Chinese restaurant? How many of you order Mexican Cola, God help you, in a Mexican restaurant, or German Cola in a German restaurant? And for some reason, people have a taste for variety in beer and they're not so strongly captive. For cola drinks, it's exactly the opposite. They have a tremendous demand for uniformity. And it's reinforced by high purchase frequency. You just tend to buy those things out of habit. And that's why the powerful brands are not the ones with big brand images. Once, presumably, you get addicted to Starbucks coffee, it's very hard for an entrant to break that addiction. And a powerful brand, not because your self-image is tied up in the idea of yourself as a Starbucks coffee drinker, but because you are subject to captivity to the Starbucks brand. I'm assuming that's the case, Joe.
Well, I was talking about the fact they can charge $5 or something.
But why sustainably can they do that when Cadillac can't? Why don't a lot of other people come into that market and do the same thing and just break it up so that everybody just barely makes a return because the crowds are small? And presumably it's because if Starbucks is indeed a sustainably powerful brand, it's because people are captive to Starbucks in some sense. By the way, the history of food is that the higher up the food chain you go, the greater the demand for variety and the lower the demand for uniformity. So that in low-end, in snack foods, you tend to have a lot of captivity. In high-end gourmet foods, the last one of these was Krispy Kreme, you tend to have less captivity. In restaurants, in fast food, you tend to have a fair amount of repeat business. In restaurants, there's very little customer to see very valuable franchises. Well, there are two other reasons why you might have customer captivity that would support these above average returns. And they are, first, that it's just hard to search for an alternative. And it's hard in two senses. You try and find a better plastic surgeon and you fail, you're going to wind up with a nose that you never dreamed of. So there's a big risk because there's big quality dependence in that service, and if you found a plastic surgeon you're comfortable with, you're going to tend to be captive to that plastic surgeon. Also, it's very hard to collect information on what's a better alternative. Hard to search for an alternative. An entrant is going to have a hard time shaking customers loose from an incumbent. The third reason you may have customer captivity is that there are just physical costs of switching. It's just a pain in the butt to change your credit card account, to change your bank account in the old days. You've got to wait till all the checks clear. You've got to change your automatic payment options if you have your utilities paid automatically. You have to physically show up and sign cards at the bank and so on. It's just a big cost of doing it. You want to switch from Windows, it's a big cost of learning alternative systems. You've got SAP installed in your company and it's actually working. Trying to go through all the dislocation of changing that out for something else is going to be very hard indeed to do. So you also sometimes have switching costs. But notice that idea of what constitutes effective differentiation is not a traditional brand idea. Branding is not at the heart of it. What's at the heart of it is customer captivity. The surprising thing, however, is you would think that better access to demand or lower cost would exhaust the possibilities. But there is one more source of competitive advantage that is absolutely crucial in an economic sense. And it is, the language is that my competitors cannot enter and compete with me because they can't match my scale of operation. And there are benefits to scale. There are economies of scale. We have the same basic cost structure. In some sense, we have roughly the same access to demand, although if that's the case, you're not going to get the economy of scale advantages. But because I'm starting at a bigger scale, and there is some small amount of customer captivity, so I can defend that scale, I can make money when they can't. And the classic picture of that is actually this one. Notice both people have the same cost structure here. But it's a declining average cost. You could also get, by the way, economies of scale from network effects in demand, but it could just be a more valuable service. Suppose I start out with a demand up there, and the entrant starts out with a demand down there. And the only thing I require is that there be some small degree of customer inertia or captivity. So if I match the entrant on price, those customers will stay with me. So we're both charging the same price, we both have the same cost structure, but if there is that customer inertia, the entrant's demand stays down there where he can't cover his fixed costs and he loses money, and at the same price, my demand is way up here and my fixed costs are much lower and I make money. I even have the capacity to actually undercut the entrant on price. And it is absolutely crucial that there be some inertia. What's going to happen is this. You're going to split the market equally and nobody's going to have a demand. That's very much what seems to happen in airlines. That people will fly mostly the airline that's cheapest. After a while, everybody's got frequent flyers on all airlines. They split the market equally and nobody seems to get, unless they've got a focused geographic strategy. The picture is like this. There's no advantage to scale. It has to be the one I showed you before, where there's some customer captivity. The second thing is that you cannot be in a very big market relative to the size of the fixed costs. Because then the differences between the situations of the incumbent and the entrant are not going to be that large. So globalization is the enemy of these advantages. The way to think of it is that if you want to protect this market, the target share that an entrant has to get to be viable has to be significantly large. If an entrant can survive on 2% of the market, it's very hard for you to keep them out, because they can almost always grab those small pieces. But if it takes 15 to 20% of the market, because fixed costs are that large to be economically viable, then it's going to be much easier to keep the entrant out. And what's going to enable you to have an advantage, even with the same cost structure, is that with a small degree of customer captivity, entrants will find it daunting to reach that necessary scale of operation. You'll have advantages that will enable you to keep them down below this kind of a position, and you should be able to make money in a sustainable way. Now, what are examples of cases where there's not a lot of fixed costs? The internet is really one. Unless you've got network effects or some sort of economies of scale in customer acquisition, the market is very large because it's a national or global market. And the costs of setting up the websites or systems are really quite small. So the internet typically is the enemy of profitability, not the friend of profit. Globalization is something that by expanding the size of the market, in many cases without raising the fixed cost you need to develop the products, means that people can survive on a smaller, is the enemy of profitability. The other thing you have to keep in mind about scale advantages is it is scale. Remember, the key thing is that your fixed costs be lower than your competitors' fixed costs. What that means is that if you just have big size, because say you're an HMO in Los Angeles and Dallas and Chicago and Miami and New York, and you've got 10% of each market, you have to replicate the fixed costs of signing up doctors, and the network benefits of signing up more doctors are specific to those markets. If somebody has 40% in New York, in that market, they're going to have the economy of scale advantages. And while there are global markets that seem to be dominatable by one or two companies, and even then they tend to be focused in product lines, there are lots of geographic monopolies, there are lots of narrow product line monopolies, and there are some national brands. But you've got to ask the question, what is the basic market that determines fixed costs? And you want share of that market to have economy of scale advantages. Now, there is one last thing that's absolutely crucial about these economy of scale advantages, because as value investors, you're interested in the long run sustainability of advantages. If you think about proprietary technology advantages, typically you will have an advantage in your own technology. You'll have a patent in a particular technology. But as the technology advances and that old technology dies, what happens to your competitive advantage? It goes away. You don't have any advantage usually in pursuing virgin technologies. If you're selling dresses and have or clothes to teenage girls, they move on. It wants variety. You don't have any advantage in recruiting or making captive the virgin customers. Virgin customers are almost by definition up for grabs. If it's a new market and there are a lot of virgin customers, there's going to be a lot of entries. So first mover typically won't get it. You characteristically want to be there when you can grab a large share of the market. So both static cost advantages, which is proprietary technology, and static demand advantages or customer captivity tend to die over time. But economies of tend to apply to the acquisition of new technology and to the acquisition of new customers. Think about Intel. Intel goes through generations and generations of chips. It's the best chip forever in each generation. No, they typically don't. From time to time, AMD does better or somebody else does better. But in the long run, who typically seems to produce the best chips generation after generation? They continue to dominate the market. And there seem to be two reasons for that. One is customer captivity. The big PC manufacturers are used to working with Intel, trust Intel, and in particular Microsoft works well with Intel. So that typically if Intel has a successful chip, it will capture 95% of the market. If AMD has a successful chip, how much of the market are they with less? Maybe 10, maybe 15%. That's customer captivity. But once you've got that customer captivity, how much can Intel afford to invest in each new generation of chip if its return is to capture 90% of the market? It can pay 15% of its already 90% share, which for Intel now is about $6 billion a year. If AMD can afford to pay a tenth of that, they're lucky. If in search of new technology, one player is spending $6 billion and $600 million a year, who do you want to bet on in the long run in that race? And the answer is clearly Intel. And that's why generation after generation, the combination of some customer captivity plus economies of scale in R&D and in manufacturing process R&D leads to a long-term sustainable advantage. The same thing applies in the case of Coca-Cola with customers. That because Coca-Cola has big economies of scale and distribution, they can service cost than a new entrant or somebody with a smaller market share like Dr. Pepper in a particular region. That means that the value to them of acquiring a customer is much higher than the value to Dr. Pepper or a small local drink. And they can therefore profit more on the fixed cost of advertising and sort of infrastructure to acquire outlets than their competitors can. And that's just, again, this combination of some customer captivity, and although in Coca-Cola's case it's powerful, and economies of scale. So what makes a powerful brand is not brand image. It's not share of mind. It's the combination of customer captivity and economies of scale. And the economies of scale are critical to sustainability in the long run for these things. Now, there are other competitive advantages that it's worth mentioning briefly. Sometimes the government is your friend. The EPA keeps a lot of potential entrants out of business. And that means if you're protected by the government, you can charge a fortune. The extraordinary lesson of this is that inadvertently you're pretty much assured that nobody new is going to be getting into the cigarette business. So the cigarette companies can afford to charge almost anything. And they therefore, because they have that powerful monopoly, have been profitable in the face of the most determined assault. But that's relatively rare. In financial markets, are the harder. Suppose I dominate the market for loans to tobacco growers or tobacco processors in North Carolina. And Deutsche Bank decides to come into my market and make a loan. Well, who's got the good access to information, both based on history and based on knowledge of peers or customers who I can go to about the quality of that borrower? I do. I know much more than Deutsche Bank. if Deutsche Bank's loan is overpriced, that is, they're not giving the guy a good enough rate given what a good risk he is, so they just happen to have gotten lucky, what am I going to do? Am I going to let them go to Deutsche Bank? Absolutely not. I'm going to match their loan or undercut it slightly. And usually, because it's a pain in the butt to change banking relationships, I'm going to keep that customer. But suppose Deutsche Bank makes a mistake, and they make a loan at below cost to a bad risk. What am I going to do in that case? I'm going to let Deutsche Bank have it all day long. I'm going to call them in and say, I'm really sorry, I can't match that loan. Go to Deutsche Bank. And what's that going to do to Deutsche Bank's attempt to get into my market? It's not going to work out. It's an advantage that shows up in financial markets, and it's based on information. And in some sense, it's what we're talking about, a search strategy that puts you on the right side of the trade. But for most industrial and other companies, if you are going to buy a franchise, that is, you're going to pay for earnings power in excess of the asset value that's there, you better be able to point to customer captivity or proprietary technology. And if you're paying a lot, so you're counting on those advantages being sustainable and that level of earnings being sustainable, you're talking about that coupled with economies of scale in the relevant market. Sorry, you had a question?
Yeah, I mean, theoretically, that's right with like your example of a backer grower, but in practice, the person making a loan in the bank has every incentive to make the loan because he doesn't give any ding to his salary if the loan
Well,
doesn't
there
work
are
out.
loan committees that should.
Well, that's assuming they're rational and they're not.
Let me tell you what I know about banking profitability, because I've actually looked at this. Even if you look at a bank that you think would do well outside its core market, like HSBC, they are much more profitable in their core markets than they are outside of its markets. So the evidence seems to tell against that. And just the logic of it seems to tell against that. But if all banks were just making loans at random, how could you make a ton of money? Hiring decent loan officers, right? And it doesn't seem that, given the systems people have got, that pays off some. So the critical thing when you look at franchises are proprietary technologies, customer captivity, and economies of scale. Adam.
Just a question on the customer captivity. So you kind of mentioned that branding is not it, but I don't really see the disconnect necessarily there. Can you kind
Well,
of
okay.
because
There are
have it-
powerful brands that are not profitable. Maytag, Hoover, which is a synonym for vacuum cleaners, Mercedes-Benz, Cadillac, old names. I mean, how many people here think that Colgate toothpaste, how many people think of Colgate toothpaste as something?
But I still think of that as a branded product. Maybe it's not like
No,
the epitome
no.
of.
The question, Adam, is, are you using the phrase brand in a very precise sense? So you discriminate between that brand and Cadillac and Mercedes-Benz? Or are you using that brand idea carelessly in a way that's going to get you in trouble? What is it that makes Colgate a powerful brand? Do they do a lot of advertising on television? Do you guys all think that the only way you're going to get laid is to brush with Colgate toothpaste? Or the only way you're going to get a promotion is to brush with Colgate toothpaste or get a good job? What is it about Colgate toothpaste that makes...
And that's what I'm saying. You were talking about low-cost things that create habit where people come back frequently to it, but how do you get to that point?
The interesting thing about habit is that it's typically not something you can do. So that, for example, in beer, do you think there's as much customer captivity as there is in cola?
Cola?
Yeah. There's not. It's the example we just gave. People have a demand for variety in beer. In clothing, even though there are powerful clothing brands, do you think there's a lot of customer captivity? No, because people like different brands. On the other hand, in toothpaste, do you think there's a lot of customer captivity? Yes, there is. Who knows?
Yeah, that's what I'm saying.
Why people look? I'll give you an example. Marlboro is one of the few truly global brands. It has a big share in every market. Why is that? I have no idea. But it's certainly not because every Chinese 16-year-old male or female wants to be a cowboy. I mean, you would think that the brand Marlboro Man imagery would, yet somehow there's something about those cigarettes that travels. What I'm trying to say to you is that it is rooted in quite specific consumer behaviors. It's not something that you can typically create by advertising. If it were, which is the category that advertises most? Who advertises enormously? Cars. Have they managed to create customer captivity? No. This is just an aspect of markets. What you as an investor have to distinguish between is markets with customer captivity and markets without. And what we're going to talk about next is mechanically how to begin to do that. Okay? I can't give you a good answer. But what I can say to you is, Adam, you're better off not thinking in terms of brands indiscriminately. You're better off thinking in terms of economies of scale and customer captivity.
Well,
Yes.
just to add to that, is it inappropriate then for a firm like to buy a Maytag, for example, and pay a premium for that if we don't have?
What do you think? If there's no customer captivity and economies of scale, should you pay for a lot of Maytag earning power?
Well, I might bring that to the table. Right? I might have the economies of scale personally. I might have.
If you do, what's going to be the nature of that market? It's going to be a market that you dominate.
Right.
And you're going to have customer captivity. But if that's characteristic, economies of scale, and customer captivity of that market, then Maytag should have it too. Look, if you're in the cigar business, does buying Maytag help? What have you got to be in to make buying Maytag worthwhile?
The manufacturing business.
Well, how about the appliance business? Because that's where the economies of scale are going to apply, right? If you're making cars, are you going to have economies of scale in making and distributing appliances?
Yeah, something that's leveraged.
Sorry?
I see something that's leveraged.
Right, but what typically is leveraged?
For the large scale appliances.
No, for any products and appliances are not going to be leveraged. What are the costs that you would save in appliances by putting it together with a car? Are you going to sell appliances through car dealers? So are there going to be any synergies in distribution? Are you going to manufacture appliances in car plants? So there are going to be any synergies in production? Are you going to put Maytag appliances on the top of your car in your ads?
I mean, I agree with you. That's all I'm saying is that's the point of view type of analysis where I would actually look for a potential buyer of this. But that potential buyer might be willing to pay the premium of it just because it is leveraged.
Right, but what are you going to ask that that buyer have? Again, you don't want to be promiscuous about this. You want to be disciplined. What are going to be the characteristics of a buyer and the product that he's buying that are going to justify a premium if you think that's going to happen?
I agree with you. I guess
No, you can't agree with it. It's a question. What are those characteristics?
Well, it's sort of what you said. I mean,
Well, that's always a good answer.
well, I mean, look, all right, to make it specifically, right?
Yeah.
So it's what I said. The point is, if there's some synergy in distribution, if there's some type of crossover in terms of where they can sell.
And do you think, by and large, all right, it turns out that basically the only things that travel in acquisitions, remember, you've got three kinds of competitive advantages. You've got proprietary technology, usually that can be licensed. So that typically you don't have to buy the target company with that. Second thing you've got is customer captivity. But when you put together captive Coke customers with captive Mountain Dew customers, do the Mountain Dew customers suddenly become Coke customers? No, it is in the nature of customer captivity that there are no synergies. So when people try and pretend there are demand synergies, and you'll hear this ex post from everybody who ruins this company by believing in them, that by their very nature, they don't exist. So what are the synergies going to look like? Economies of scale. And how are you going to be able to measure the cost savings that you'll incur, that is the cost you can get without usually incurring? And that is an easy thing to use. How many acquisitions do you think are justified in terms of the cost savings? You remember the Time Warner acquisition? They paid a premium of how much? 120 billion? They thought they were going to pay for it with 100 billion in pre-tax cost savings. So it's not that I'm arguing that this doesn't appear, but what are you always going to look for? The benefits of economies of scale, which involve some customer activity, but economies of scale in some back-end function. Yes?
If you looking at a startup, and you try to evaluate how simple investment.
Wait, sorry, if you...
If you're looking at investing in a startup,
Right.
and you want to see whether that's going to be a good investment,
Right.
it just seems to me it's going to be very hard to evaluate whether or not you're going to have captured customers, because you just said...
Well, is that hard to evaluate?
It seems
In
to
a
me-
startup, do they have any customers?
Well, exactly, they don't.
So, okay, so they don't have any customers. So can you have captive customers without having customers?
And that's the point.
Well, wait a minute. Just answer that question.
No, of course not.
Is there any uncertainty about your answer to that?
No.
So is there any customer captivity for a startup?
No.
No. So when you're investing in a startup, are there any competitive advantages?
Not as far as captive customers.
Right.
They might
And are there economy of scale advantages for a startup?
No.
Does it have any scale? No. So we know there's not that. What's the only thing a startup can have? Proprietary technology.
But let me just ask you a counter question. We just, using this method, we saw this Starbucks trying to be a big business. But using this method, we would not have been able to identify...
Yes,
Starbucks.
exactly. You are there. Think of the many people who tried to invest in restaurant concepts before Starbucks. How did they do? Not too damn well. There are more restaurant chains that crashed and burned than almost anything else. So is it wise for you to expect an investment technology that will identify successfully every subsequently profitable firm? And is Starbucks, if anything, an exception to a general set of rules? So if you go out looking for Starbucks, which is what growth investors do, what's the overwhelming evidence about their performance? Exactly. Because that's what everybody wants to do. Everybody is saying to themselves, crap, I miss Starbucks. Except everybody in this room should next say to themselves, damn good thing too. Because I missed 150 bad investment opportunities that didn't get me this stuff. Okay? When do you want to invest in a startup? What a startup has, and this, by the way, is characteristic of good venture capitalists. Do they look at the business plan or do they look at the people? Why? What are they buying? If you're buying the business plan, what are you buying? Strategic advantages. We don't believe there are any strategic advantages in startups. What is value going to reside in? Well, operational efficiency, or basically there are two things. There are assets and there are franchises. There are no franchises. What are you going to do to invest in? Assets. What are the assets of a startup? The people. Okay? All right, how can you go about assessing the extent to which these competitive advantages exist? Is there a cookbook here? And the answer is pretty much. There is certainly a procedure that you can follow. The first thing you want to do is, when you're looking at a potential industry, and what we're going to do is actually talk about Apple briefly, is first, industries have a lot going on. If there are many sectors tied together, you're asking for confusion if you try and evaluate them all at once. So what you have to start off with is a clear picture of segmentation in the industry. That's an industry map. It's just identifying segments and looking at which of those are essentially joined at the hip and which you have to analyze separately. Then you want to look at the history and say, do barriers to entry exist? There's no history, you just got to think about it and see if barriers exist. There are two characteristics of industries with barriers to entry. One is they have sustainable, above average returns on capital, especially for the dominant competitors. And that's just an aspect of the competitive advantages showing up. The second thing is that they have share stability. That's the barriers to entry aspect showing up. And you want to look for both. If you then see that it's an industry that looks like there are competitive advantages, then you want to verify that those advantages exist in terms of customer captivity, proprietary technology, or customer captivity and economies of scale. And once you understand where the competitive advantages are, you ought to be able to think about threats to sustainability, how far they're sustainable, and how valuable that franchise is going to be in the future. Now, I'm going to do this for Apple. These view graphs are like almost 8 years old now. And they just, the prediction that they've been making all along just came true. I'm going to look at Apple first in terms of personal computers. If I look at the personal computer industry, I right away have to start writing down segments. I've got chips. I could have broken up chips into CPU chips and memory chips. I'm not going to bother, actually. I've got hardware, which is the people who put the machines together and put their brand on it and sell it. I've got software, which I can break up into applications and system software. I have networks like AOL, Microsoft, MSN, and Yahoo. And then I've got a whole bunch of segments that supply chips and power supplies and screens and so on. You should start with as exhaustive a list of these as you can handle. I'm going to leave the components aside because you'll see they all look the same and they're relatively easy to get your arms around. I'm not going to separate initially into software, that's system software and application software. But if you're in any doubt, it's easier to operate with a smaller number of segments than a larger number of segments. But for the moment, I'm just going to do this. Once you have your list of segments, just for each segment, write down the prominent firms in that segment. Don't do anything else. Don't try and think who's profitable or not. Don't try and think who the dominant competitor is. Just start writing down names. And that will tell you a great deal. If you wind up with 15 or 16 names, what does that suggest about barriers to entry? There are not a lot of them. That's probably a competitive industry if you define that market properly. It's a long list of names. If it's a list of names that varies over time, if there's no name there with a big stock market value, it's probably an industry without any competitive advantages. And if you think of components, you think of memory chips, you think of screens, you think of motherboards, you think of all the pieces that go into personal computers, there are not a lot of those companies that you put in. The closest is Hewlett-Packard, actually, with printers, but even then, and Epson, but even then they're not great big value producers. That's why I'm putting components together. In each of those segments, you see long lists of quite different names that are unstable. In chips, it's Intel, AMD, Motorola, and Apple. In hardware, it's Dell, HP, Gateway, IBM, Compaq, and Apple. And Microsoft, in software, it's Microsoft, Apple, Oracle, Netscape, and others. And then in networks, it's AOL. Well, notice the names are entirely different in each of those 4 segments. For the purposes of looking at Apple, I'm just going to look, obviously, at 3 of those segments because there's no Apple network I have to worry about. So just writing down the names tells me that those are really quite distinct segments, and I'm going to analyze them separately. If in doubt, if the dominant competitor in 2 segments differs, if it's a different dominant competitor, treat them as separate segments. Okay? So now I have 3 segments that I'm going to look at. I'm going to look at chips, hardware, and software. If you have any doubt, treat the segments separately. You can always go back if you find out that they're really essentially the same. Next thing I'm going to do is look at the history of profitability, returns on capital, and stability of returns on capital over time. And when you do that, you see that Intel has had huge returns really for, by now, 20 years on invested capital, especially if you strip out the cash. In hardware, the returns are both lower and much more unstable. Intel does well almost every year. The hardware companies have good years and they have bad years. They're much more highly leveraged. The returns fluctuate a lot more. You've got losses in given periods, and you have much less stability under those circumstances. In software, as Microsoft made good returns on capital. They report returns of about 15%. But basically, they have 2 businesses. One, which used to have about $80 billion in capital invested in it and earned about 2% after tax, 2.5% after tax. And one that had about $5 to $10 billion invested in it that earned about 100 to 200% after tax. And then you average them together, you got a respectable return of about 25%. And they are, of course, cash in the bank and the software business. They are enormously profitable in software. And they're stably profitable over time. So if you look in terms of profitability, it certainly looks like there are competitive advantages in chips and software and problematic. Next, you're going to look at share stability. The first thing you want to look at is, does the identity of the dominant competitor change? Who's the dominant company in software really for the last 25 years? It's Microsoft. Who's the dominant company in CPU chips for the last 25 years? It's Intel. So again, in both those segments, it really looks like there are significant competitive advantages and barriers to entry. If I look at the history, though, of PC manufacturing, who was the original dominant competitor? Apple. Who were they displaced by? IBM. Who were they displaced by? Compaq. Who were they displaced by? Dell. Who are we afraid is going to displace Dell? Chinese or low-cost manufacturers. But the thing is, the history of dominant competitors is much different in that segment than the others. Also, there's been significant entry there. There hasn't been a significant entrant into chips and software for a long time. Lastly, you can actually compute a share stability. And if you're in doubt, it's worth doing. Take 2 years that are usually at least 4 to 5 years apart. Look at the market shares of the 4 to 5 dominant competitors. In the first year, Compaq had 28, IBM 18%, Apple 22%, and Dell 4% of the market in 1990. You did it again in 1998. Compaq had 30% of the market, IBM had 12, Apple had 14, Dell had 20. Those 4 competitors had 72% of the market in 90, 76% of the market in 98. Go ahead and translate into 100% of the market. So divide all these numbers by 72, divide all these numbers by 76. So you're looking at share of the top 4 companies. In those terms, Compaq was 39 and 39, IBM went from 25 to 16, Apple went from 31 to 18, and Dell went from 6 to 26. Then just compute the average absolute change. If you compute the average algebraic change, it has to come to 0. So look at the average absolute change. There's no difference here. It's 9 points there. It's 13 points there. It's 20 points there. The average absolute share change is about 10 to 11%. That is extremely high. That is completely characteristic of a market without barriers to entry, because people can steal share from each other and there's not a lot of customer captivity. If we did this for Coca-Cola drinks, what do you think the share stability would be? Under 2%. It'd actually be close to 1% overall. So you can look for share stability and implicitly customer captivity by looking at the history of market share changing hands. But when I look at both those indicators, it looks like in chips and software, there are clearly competitive advantages. There are high barriers to entry. In hardware, it's more problematic. It's more likely to be a level playing field. What I look at next, then, is the sources.
Isn't Apple challenging that now?
We'll talk about that. Hold that thought. Well, next I want to know the nature of barriers to entry. And in chips, is there customer captivity? Are you tied to Microsoft? You bet. Until they have a fully portable system, you guys are stuck. Secondly, are there economies of, does Microsoft have proprietary technology? Can they do anything that other software writers couldn't do? The answer is actually not. That people write better systems than Microsoft. That there are lots of computer science departments there. It's almost certainly not proprietary technology. They stole most of their technology, first from a company called CPM, and later from the Apple Macintosh for the Windows environment. But do they have economies of scale? Yes, it's an entirely fixed cost business. And there are big network externalities in using the same system. So in chips, are there in software, are there competitive advantages? Yes. Is Apple on the right or the wrong side of those competitive advantages? Wrong side, in the general system software market. There are two special markets where they are on the right side, which are education and, in these days, desktop publishing. In education, is that advantage likely to be sustainable? Some of you are shaking your head, but why not? Because you can't train people on machines they're not going to use later in life. And of course, Apple very quickly. We'll talk about desktop publishing in a second. In chips, sorry, that's software. In chips, are there captive customers for Intel? Yes, it's very hard to get the big computer manufacturers to switch. Are there economies of scale in chip production and design? You bet. Are there proprietary technologies? Yes, there's some, actually more than in software. On the chip side, is Apple on the right side of the competitive advantages or the wrong side? It's on the wrong side. That in the long run, Intel is going to do better at developing new chips. In hardware, the share stability data suggests there are few captive customers. There are no proprietary technologies, at least in principle, economies of scale in Dell's model of make to order. But again, they're small, and Apple doesn't have them. What's Apple's strategy in this market, Mr. Synergy? What is it? No. What's their? Did they decide to do all these things and tie them together? Yes, they did. They made their own chips. They had their own operating system. Apple decided to enter all three markets. So the Mac has a Mac operating system. It used Motorola chips, and they make their own Mac. So they're in all three segments. What are they counting on to beat their competitors here? Synergies, right? Well, what do the synergies really look like? They're competing at a decisive competitive advantage in CPU chips, disadvantage in CPU chips. They're competing at a decisive competitive disadvantage in software. And they're probably facing a level playing field for the machines. So when Steve Jobs decided to swim in this race, what had he effectively done to make sure he won. He tied 2 huge blocks of concrete to his ankles. He tied himself to 2 huge competitive disadvantages. So even when he was a genius and he produced these colored iMacs, what was going to happen sooner or later? He was going to get rolled over by Intel chip technology, which he couldn't keep up with, and by Microsoft software. And what did he finally decide to do? Finally decided to use Intel chips. Is that going to be enough? No. He's going to have to go to a Windows environment too. He's going to have to offer Windows also. So when you saw Apple with all those colored iMacs do really well and show earnings power well in excess of their asset value, what should you have concluded? That that was sustainable or not? That was not sustainable. Where when you do the strategic analysis, the competitive advantages are on the wrong side. I'm sorry, did you have something else you want to say about Apple's?
No, I was just going to say that was.
They did, but is that enough? And in fact, in the one market where they had captive customers and economies of scale, which is desktop publishing, what happened to Apple? They are now down to about 30% market share from 90% market share. Even with those competitive advantages, they were offset by the disadvantages of the synergy strategy. They would have been much better off doing what Adobe did and just selling the software. Last question, and then I'll let you go. What's the future of the iPod? Do they have proprietary technology there? No. Are there big economies of scale in making iPods? What industry does it look like? Consumer electronics. Are there big economies of scale in consumer electronics? Don't bet on it. Is there customer captivity? Is there? You buy an iPod. Does that keep you from buying another one? I bought an iPod now, and all my songs are on an iPod, so I may not be able to move. What does that do to iPod sales? Well, if I could transfer them to new iPods, I could transfer them to new other things, right? They have to be able to make an arrangement to do that.
But if you're in the habit of buying from iTunes.
iTunes is different. We're just talking about iPods for the moment, Josh. When somebody buys a new MP3 player, which is what an iPod is, are they captive customers? Does this look like Coke and Marlboro, or does this look like Maytag and Mercedes-Benz? Think about that.
It's
Yes.
not the economies of scale.
Yeah.
What if they, is it just a temporary thing that they've bought up all of the supply of the memory chips that are used
Please. You think the world can't produce memory chips?
well, for like the next 2 years.
That's extremely unlikely. I think the world can't produce memory chips, Josh.
I think the world can, but it just so happens that
I don't know who told you that.
Well, no, but for this.
Well, look, let me just ask this. Is noise storage a big storage problem?
Are you referring to recorded music?
Yes. Is storing noise use a lot, or storing voice use a lot of memory capacity?
No.
Does storing pictures use a lot of memory capacity? Yes, it uses enormous amounts compared to noise.
Well, in the scheme of things, not so much.
Well, but if in the scheme of things, not so much with pictures, and each picture is many, many more bits than each song, why is there a storage and memory problem with music?
It's not. First of all, I don't think that's correct.
Josh, I hope your father didn't tell you this.
No, I was not listening to him years ago. But
Who did you hear this nonsense from?
I don't know. I guess the Wall Street Journal.
Look, I don't know the facts, but it strikes me as extremely implausible that they would dominate the market for a commodity like memory chips as a purchaser what fraction of all chips in the world do you think really like?
80%.
Of the chips in the world?
No, but of the things that are in the product category.
Yeah, but how many people can make those? I mean, please, Josh, lots of luck to bet on that one. Yes.
How about Steve Jobs? So now, Apple is a new thing, and then would we say that it's not going to be, they're not going to have a competitive battle with this, but then Steve Jobs is a good person.
He may be a genius.
He's
He
going
may
to
be
come with
worth a
another
lot.
product, maybe, so he's going to keep on innovating and
He could. And he did extremely well keeping Apple alive in the face of all these competitive disadvantages.
until he
But now, do you want to bet on that, or do you want to bet on Bill? That's the heart of the judgment you have to make. Are there really geniuses out there who are consistent geniuses? And if you believe in that, you ought to be able to point to a lot of geniuses. What we're going to do next time is look at brands. We're going to look at Liz Claiborne. I'll see you on Thursday.
I'm sorry, Robin. Like,